Before we get to today's chat, just a quick disclaimer. This content is for educational and informational purposes only and by no means financial advice. All investors are encouraged to do their own due diligence and are responsible for their own investment decisions. Investors, welcome back to another go-round worth of Masters of the Market. This week, I couldn't be more excited to have on with me Bilaal. You probably know him better off by his handle across social media, which is BD Investing. But Bilaal, welcome to Masters of the Market officially. What exactly is your story and how'd you get to where you are today?
Oh man, where do I start, Ari? You know what? I'm gonna save us all the details started from the bottom stuff. I'm gonna get into why I started investing. Like other people, we all aim to, get a career and better extend ourselves, earn some money. Like I started working at 16, but then I would say I got my first career in the corporate field at around 20. I'm an electrical engineer as a background, but I started as a boring AutoCAD desk job. That was too boring, so I moved into more of a hands-on technical role as like an electrician. And by the time I was 21, 22, I was earning over six figures. And I always say the story, by the time I was done buying all the video games, all the Air Forces and the Jordans, I was privileged enough to have enough money left in the savings account. And I'm like, okay, well, what do I do with all this money? Like, I'm getting bored here, and I need to, double that money, triple that money, and maybe start a side business or something. And putting in a savings account, earning 1% interest wasn't exciting enough for me. I started researching. I started asking my coworkers, hey, like, what are you guys doing? Are you guys investing? How are you growing your money? And some of them said real estate, but I live here down in Toronto, Canada, where real estate prices are skyrocket. So it wasn't just getting $1 million mortgage wasn't, so exciting for me. I really don't like debt. I try to stay away from debt as much as possible. And then a coworker told me about the stock market, Warren Buffett, and I was like, the stock market? No, that sounds like a scam. People always lose money. But that was just my belief, right? Because I was being ignorant. I wasn't being open-minded. I should stop thinking like I'm very smart, and I should just try to do some research and actually be open-minded and look into what the stock market is. Because everyone called it a scam, but hey, let's look into it. Let's see if this is actually a scam. So then I fell across a guy called Warren Buffett. I think maybe you know him. Started doing some research on Warren Buffett. Found out he's one of the greatest investors of our time, probably in history. And I really liked his principles of, of dividend investing, earning money while you sleep, passive income. All this stuff was very enlightening to me. And that's when I first started getting to dividend stocks. And I think my first couple dividend stocks was like Apple, Google. Down here in Canada, we have a bank called TD Bank, and it's an excellent quality dividend payer. You can't go wrong with the banks. Can't go wrong with Coca-Cola. Coca-Cola was gonna stay around forever. And I use my iPhone every day, so I'm like, hey, what could go wrong picking these stocks? And I think I started with about $1,000 invested. And oh my God, Ari, when I first got my Coca-Cola dividend, even though it was like 25 cents, man, I was so excited. I was like, yes, I'm finally doing something here. It's working. It's working. Passive income. I'm going to get rich in no time. And then a couple months went by. I think my account probably grew like $100. It excited me, but it wasn't exciting enough. So I think I started dividend investing for a year. And then the market crashed. It was during the 2020 pandemic. And I was freaking out. I was like, whoa, what's going on? I've never seen this. But then I went back to my old principles of Warren Buffett, which was, hey, don't panic. This is, when others are fearful, you be greedy. That's when I decided to look into more growth. I started investing into tech stocks like Apple, Google, Microsoft, Tesla, bought all these tech stocks, decided to invest as much as I could. And I was doing so much overtime at work, kept buying the dip. And I'm not saying I was perfect when it came to buying the dip. Obviously, I was panicking because I'm like, hey, maybe this pandemic is real. Maybe it could be the one where everything's over. But I just said, hey, if the world's gonna end, who needs this money anyways? I might as well keep investing, keep grinding. I still have a job, thank God. To this point, I've been using the same principles. Like I usually invest time and time, weekly, week by week, by month. But when it comes to, crashes or when people are fearful, I go extra heavy. I do that extra double time shift. I try to work on weekends as much as possible. And with these principles of me investing, doubling and tripling down during times of fears and market crashes, I've grown my portfolio to over $500,000. And my goal is to hit $1 million by next year and hopefully retire and quit my job. So let's see what happens, Ari.
First and foremost, for anybody who's interested in actually looking into Bilal's portfolio, you can actually see all of it transparently shared on Blossom. You can also follow him again across social media to see someone who is truly hustling. And I want to start there because your hustle, I mean, there's creators creating content and then there's you. And you are just a machine and you can see how much you hustle. Just behind you, you have on the wall grind. And I want to ask you, grind and execution. There we go. Bilal, I want to ask you, like, where does that motivation come from? Where does that ability to grind and hustle almost nonstop really come from for you? Because that's a key element for someone really looking to get wealthy.
Yeah, Ari, you know what? The truth of my story, which was, I grew up poor. So my parents were immigrants from India. They truly came here with nothing but $20 in their pocket. My dad was the breadwinner. So, I would say I saw him grinding and hustling day by day, nonstop. Would leave the house at 6 a.m., come back 7 p.m., get some Toonie Tuesday Popeyes on the way, feed the family. Growing up, I would ask my parents, hey, can I get $5 for lunch? It was almost brutal because you would just see their reaction. And when I was younger, I would get upset, like, why is all the other kids getting money for lunch, but I'm not, my parents won't give it to me. Maybe they don't love me. Soon I realized my father was like, we were poor. We were living in one of the poorest neighborhoods in Toronto. Growing up, I saw a lot of my friends either end up in jail or end up dead. And despite the fact that it was hard not to be influenced by them, you realize, like, hey, there's only two paths to this. I either end up dead or in jail, and that's not something I wanted. I'm like, hey, I'm gonna do it. I'm gonna do it the only way I know how, the legal way, the right way, which was grinding, hustling. And that's what made me start a job at 16. I was throwing papers at 16. By the time I was 18, 19, I was working at this place called Sky Zone, which I loved. And then I'm like, hey, I'm gonna go to college for electrical engineering. I'm gonna hustle this way. And I would say it was just concrete dreams, man. I wanted to get out of the ghetto. I wanted to be a millionaire. I wanted to retire my parents. My parents worked tirelessly day and night. So the hustle and grind just came from the fact that I wanted to retire my parents. I wanted to end the struggle with my bloodline, with my family. Say I made it, man, because now we were able to afford a better house, get out of the neighborhood. My parents don't stress much about money. My siblings are all good. And I would say I'm the oldest in the family. So my brother and my sister kind of followed my footsteps by all of them invest, all of them grind, all of them hustle. And I would say we at least have some light at the end of the tunnel, I would say.
It's a powerful story, and one that I think we can all use for inspiration. Something that I'm always curious about from someone in your shoes is whether or not those who don't come from the immigrant background, right? The immigrant family background where it's like this hustle it's real and it's there and it's prevalent in almost everybody that I've had on that's come from an immigrant background. Can this type of work ethic and hustle be matched or beaten from someone who doesn't come from that background?
I mean, it's hard to say because I've never been in that place of extreme privilege. I would say, why not, right? It all matters. Like, do you where? Because, like, there's a number for everyone. For me, for some people, $1 million is the end goal. For some, it's five, maybe it's 10, maybe it's 100. So why can't it the same for you? Because at the end of the day, I would say to be successful, it really comes down from the type of individual you are. So if you want a better life, definitely be grinding day and night for that. So I think it could be found anyone. Everyone truly has it. Like, I'm not special, right? I'm just an electrician. All it came was I was consistently like, I'm always consistent. I wanted a better life. I'm ambitious, and I think if you have these traits, then it's definitely possible.
I've had teachers on the channel. I've had people on Wall Street on the channel and everybody in between. I think you're the first electrician that's actually on the channel. But I want to ask you about this traditional route of going to university, maybe getting whatever X degree and going more of that traditional route versus the route that you took. Do you find that people are missing the point?
I feel like nowadays people just chase titles. They want to seem important. They want to get that Ivy League education and kind of use it as a way to show off, but they're truly not happy. And I can't speak for everyone, but majority of the people I know that have like a fancy degree or fancy title at work, they're truly not happy because at the end of the day, they're still working a job, right? And I'm not saying that my job makes me happy. I mean, we all have good days, bad days. But at the end of the day, you'll never be happy working for someone else. You'll always be happy knowing you're working for yourself versus for someone else. And for me, at least investing gives me that light at the end of the tunnel. Truly do feel like I'm working for myself, and I've come to a place of comfort where if I truly wanted to give the middle finger to my boss, I could because I got a decent chunk in my portfolio. You want to go to a place of you. You know, I've seen this line from a movie. You build that nest egg early to the point where if you were to get fired tomorrow, I don't care. Because I think what people don't like or what makes people depressed is another human being having control over them, their future, and that day. Like if I'm feeling sick, like I feel so bad because some of my coworkers and some of my friends, especially in this economy, they can't even call in sick. Like if they're truly feeling bad, maybe someone passed away. Like I had a coworker, one of his best friends passed away, and he could only take off 2 days of work. He wasn't allowed to take the full week to grieve. How can my job tell me that, hey, I can only grieve for 2 days? And that truly made his depression even worse. But to your point, Ari, I think people need to stop chasing titles and fancy degrees and actually see what's giving them the best return on investment, right? If spending 6 years, 8 years in school, $300,000 in student debt, and then working 5 or 10 years to pay off that student debt, I don't think that's the end goal here. Why not try your efforts at finding the best? Like, for me, I only went to school for maybe 2 years. It cost me about $10,000 because it's like trade schools, and I had the option of going to university for another 2 years from that. And I'm not gonna lie, I attempted it. I did university for a month, and for me, it just wasn't fun to stay in a room full of 200 students, listen to a professor who probably didn't like his job, and that's why he's teaching now. And for me, I'm like, hey, if he didn't stick at that engineering job, why am I gonna do it? Let me pursue something else. Let me see my options. I was only 21. I had plenty of years to trial and error. So yeah, that's my opinion.
I absolutely agree with you. I think people need to start looking at the ROI at the end of the day instead of just chasing the titles, which is unfortunately true. And that's not even just opinion. You can look anywhere, even across social media, and see everybody is putting the CEO or founder in their title, right? It's people are at that. So let's get to some of this money talk though, because it is certainly impressive the portfolio that you built, the strategies that you've been actually putting forth. Like I said, anybody looking for stock ideas, Bilal's got them all day long. And, I'm certainly snatching some stock ideas as you're tossing them out there. So you started off, like you said, dividend investing. That is no longer the approach, I take it, that you were really using because you understood the power of growth in tech. But talk to us a little bit more about starting off in the market. Now that you've been invested for quite a few years, how would you actually recommend that a brand new investor, or perhaps someone who's a little bit more experienced but not seeing the luck or the success that they wish they could have, approach the market?
Honestly, if I was to start investing, from scratch tomorrow, my portfolio would consist of, like, people always underlook this is ETFs. For me, even my portfolio now, I have a nice base. So I always like to visualize my portfolio like a house. So if I'm building a house, I want a nice strong concrete foundation. And for that foundation, I like ETF. So I make like 40% of like 30 to 40% of my portfolio is ETFs, and this is just broad-based index, S&P 500, Nasdaq, whatever else you want to put in it. And then another thing people overlook is gold and Bitcoin. So gold has truly been a magnificent performer over the last couple of years, and same with Bitcoin. You cannot ignore Bitcoin anymore. And gold and Bitcoin, I like to make that about 10% each of my portfolio, and then the rest would probably be individual stocks. Now you can choose from growth stocks, tech, dividends, and I still make, even though I'm not a full dividend investor now, I still have some dividend companies because I'm not gonna lie, some of these dividend companies are quality blue chip companies, and I do like to make them a key pick in my portfolio, and that's just downside protection in case, let's say, the market goes to a more volatile era. A company like Home Depot or Procter Gamble is most likely not gonna go bankrupt, or people are still gonna go to Procter Gamble. People are still gonna go to Walmart, Costco. So these are stocks that I don't have to lose sleep on. But no, truly, I think ETFs are slept on. It's especially when I see some of my colleagues or friends that are stock pickers. They don't want any ETFs, and I'm just like, why not? You get some downside protection, plus you're following the benchmark index. Isn't the whole point of us stock pickers to beat the index? Why are you ignoring the index?
Rule number one, don't lose money. Rule number two is just follow rule number one. So don't
Yeah.
lose any money at the end of the day. But like you said, people love stock picking. So for those people who like to actually pick stocks, you're saying, hey, at least have a foundation. My follow up question for you is if you are going to become that stock picker, how many stocks should you actually have in your portfolio? How many is too many?
I had this issue, and I still feel like I have this issue because us stock pickers, when you first become an investor, you want to own everything because you know everything. You know every company. Like people can name 100 companies. Oh, I like that company. Let me buy that. I have that company. Let me buy that. But the problem is, usually beginners, what they do is they're putting $100 in this stock, $50 in this stock, $100 in this stock. Now you're too diversified, way too diversified. And when a sector starts booming, you're not really taking that profit or advantage because let's say, I only have 2% of my money in AI stocks and maybe 2% in robotics, 2% in data, 2% in like staples, 2% in space. Now, let's say, now tech and AI is booming, right? Some of these AI stocks have gone like 300, 500% in less than a year. Now you can be like, hey, yeah, I got AI stocks, but you only probably made $100, and that's because people are way too diversified. I did have this issue. I think at one point I probably owned 50, 60 stocks because we have this saying where it's like I own a piece of a company. So I remember I'll be chilling with my friends, and then we'd walk past like an Apple store. I'd be like, yeah, I own a piece of that company. Oh, I own a piece of that company. I own a piece of Target. Oh, I own a piece of Foot Locker. And then my friends go like, oh, that you already named like 50 stocks. You own 50 stocks? You must be a millionaire. I'm like, oh no, I think I only got like $5,000 in my portfolio. And they're just like, I'm not impressed. So then I started realizing like, hey, I got way too many stocks. I got too many news and earnings to follow through. I remember one point I didn't even realize one of my stocks crashed because there's just too much to pay attention to. So for me, depends on the size of your portfolio. I feel like if you have a portfolio with a size of $100,000 and less, you should only have like maybe 10 stocks and maybe a couple ETFs, but 10 individual stocks, maybe two, three ETFs. Right now, with my $500,000 portfolio, I have about 23 individual stocks. I have about three ETFs, probably two, three crypto coins, and you can see that on my Blossom. So I think I have a total of like 40, 50 holdings. And in my opinion, I think that's way too much. So I'm actually trying to cut that down. I'm trying to cut it down to about 15 to 10 stocks where I'm very confident in these picks. And also the reason for that is you want to put more money towards stocks that you're more confident in. And right now I'm extremely confident with the AI sector. From my electrical engineering background, it truly works out for me because it is a sector where I'm working in. So I'm gonna use that to my advantage while I still have this job where a lot of my tech coworkers and tech friends are still talking about AI and data centers. So I kind of get that benefit working with people that I know that are smart in that field. So I kind of, it's like a cheat code.
Let's flip the script here because while there's stock pickers, there's also ETF pickers. I don't know if you've been able to talk to any of them out there, but they have like 10, 15 different ETFs in their portfolio. So what's going on there? What are your thoughts?
Yeah, I see a lot of people's ETF portfolios, and it's like they're just overlapping with the same sectors or same stocks. Like I see some people that own like three, I would say like three ETFs that are still following the S&P 500, but one could be like, oh, S&P 500 growth. One's like the actual S&P 500 index, and then another one would be like a AI index. Across all three of those ETFs, each of them own Nvidia like at least like 10% of it. So now you have a 30% holding in Nvidia. You don't want to overlap. Like if you're going to have, like, the whole point of having ETFs is you're trying to diversify your portfolio as much as possible. At this point, you might as well just own Nvidia stock, right? I would say, like, truly know what you're holding and why you're holding it. Most people don't even look into the holdings of the ETFs, and it's pretty easy. You just go on Google, you search up VOO holdings, and then that way you can break down stocks you're holding. If I was to do a all ETF portfolio, my opinion would be, like, you want to own like one or two index ETFs, whether it's the S&P 500 or the Nasdaq, or if you want to hold S&P 500 and then, a AI sector ETF, and then maybe you want to have some international exposure in emerging markets, right? Whether that's China, like an ETF that invests in China, Japan, India, Saudi Arabia, whatever, right? These are emerging markets. And then maybe you have like a all dividend ETF. Like I own like a all dividend ETF that holds blue chip companies, and this holds like quality blue chip dividend stocks that might not be in a S&P 500 index, or might be very little. So I'll just say, hey, truly open up an Excel sheet and list down all the stocks you have holdings from each of these ETFs, and try not to own too many ETFs, because that's just money going to the same places or same sector.
Now, when it comes to ETFs, I mean, me and you were both at the, Blossom events in the last tour. Great to be up there on the stage with you. I'm sure you had the same conversations I was having with a lot of retail investors who were there, or even, with your social media channel, like platform, right? Like how many investors are DMing you about some of these ETFs that are leveraged, option oriented, they want the income, they want these crazy yields. Is that always the best move? And we can go with two avatars, a younger avatar and an older avatar.
I would say it really depends on where you are in life. So I would say if you were dirt broke like me and you had a small portfolio, I don't think like the income ETFs are the way to go, especially because of how much depreciation is in some of these stocks. Like a perfect example is the MicroStrategy, MSTY or whatever. I'm seeing a lot of people complain right now because we're seeing the MicroStrategy's performance down. However, you are getting that, beautiful 100, 200% dividend, but you're also seeing your money depreciate. That's not bad for some people. Like people that are retirees, they don't care. They're collecting their 100% dividend. Everything's happy in dividend land. But then there's people that thought that, hey, I love the dividends, but I also want the growth. And they're getting the dividends, but they're not getting the growth. And now they're worried because they're seeing maybe a 60% drawdown. And it, like I said, it truly depends on if you're investing for income or if you're investing for growth. And I think a lot of these covered call enthusiasts, or income enthusiasts, they kind of get this wrong, because they're like lying to themselves. I know, I love the dividend, but yet they're on Blossom, they're on social media, they're DMing people, what's going on, why is it MSTY recovering? And like I said, it's because you're lying to yourself. For me personally, I think I don't think you should throw shame on covered call ETFs or any of these income ETFs or stocks, because they do serve a purpose. Every ETF and stock serves every individual person a purpose. And as much as people can hate on them, my retirement plan is I choose to go into these covered call ETFs when I have enough income, when I have enough money to put there just to get income, because I'm seeing people in their 40s, 50s earning almost $100,000 of passive income on maybe like less than a $500,000 portfolio, and they're retiring from work because they're like, hey, I'm making the same amount of dividends from these dividend stocks versus my actual job. So no, I think it serves a purpose for every different kind of person. But if you are young, like me, still in your 20s, 30s, even your 40s, and you have a portfolio that's only $100,000, I think you should choose to go towards more growth versus going for, dividends or covered call ETFs.
So, Bilal, what is it exactly with this passive income dream that we're all after? Because you first started off dividend investing. It is exciting to get the dividend. I also started off as a dividend investor, excited to get the dividend. But it seems like both you and I had an epiphany moment. And at least for me, that epiphany moment was, hey, if I'm able to hit the seven figure club much earlier, and then eventually, like you just shared, transition into some of the covered call ETFs and dividend paying opportunities. That would make more sense. But what is it, do you think, that's keeping investors trapped in a, as you shared, dividend land?
I think it's the whole thought of making money while you're sleeping. The whole thought of passive income, different income streams. And for me, that's what it was is I was so stuck in this realm, I would say, of working a 9 to 5 and actually believing that my 9 to 5 would let me, you know, like I could work there for 30 years and I'll retire and I'll speed up that process by investing in dividend stocks. And oh look, I'm making money from work and I'm making money from dividends. But the truth of the matter is you're not gonna retire off of $100 of dividends a month, right? Maybe if you can excel, if you can get to 1,000, 2,000, 3,000, sure, you have some hope there. But no, people need to stop lying to themselves that that dividends is truly the way. There's many ways to retire, but I think when you're young, you need to grow that portfolio. You need to go into growth ETFs or growth stocks. Don't lie. Like you have to be real with yourself. Don't think that $100 is gonna retire you. $100 a month is not gonna retire you from dividends.
So you, once you had that epiphany and you started going growth, I want to know how it felt to start seeing the growth, because I know on my end, when I put the dividend playing cards down and I started getting my portfolio jazzed up with growth, it was wild. But we're not here for me, we're here for you. So I want to hear what your experience has been transitioning into growth and how it feels to see your portfolio growing as it is now. I mean, over $500,000 by this point. You're not even 30.
No, no, yeah. Uh, yeah, Ari. Like I'm 29, and I think I hit my first $100,000 when I was when I was 26, 27. When I saw that portfolio hit $100,000, I was like, whoa! Like all I had to do was buy growth ETFs and growth stocks. You're telling me that I didn't need to do dividends? And I'm not saying it was an easy road. It wasn't straight shot up, boom. Oh my God, I'm so rich. No, obviously it was a roller coaster. I had to manage my emotions, but it all came back down to the same thing that Warren Buffett and Peter Lynch and Ray Dalio always taught, which was you gotta control your emotions during these volatile markets. Now, regardless, even if you own dividend stocks, you would still feel the same volatility. The market isn't, the market isn't forgiving for anything. Like when the stock market crashes, everything goes down. Whether it's dividend stocks, gold, Bitcoin, we've seen it all now. Times are changing. But anyways, let's come back to the transition from dividend to growth. It did make me obviously it was a roller coaster. At one point I did regret it when the market crashed. I was like, oh man, I should have stuck to my dividend stocks. But once I started investing and doubling down on these oversold growth stocks, and I was seeing like 100% returns in less than a year, and I saw my portfolio double and triple. I was like, I felt like I kind of got the secret, I would say. But it truly did make me happy knowing that, hey, I'm glad that I had that epiphany. I'm glad that I stopped myself I stopped myself early and kind of punish myself and give me a reality check, like hey, dividends is not the way. I'm not gonna retire from a 2% growth in a year and making $100 a year from dividends. So yeah, no, I'm glad I made that decision of going to growth. Like you said, $500,000 portfolio, and I truly feel like I got the strategy down to reach 1 million by next year.
So you talked about managing emotions. How exactly would you recommend someone go about managing their emotions? Should they be making to make that switch? And then more importantly, just as an investor, whether you are a dividend investor or a growth investor, managing your emotions is key. So how do you go about the process of managing emotions?
Yeah, for sure. Okay, guys. So when the stock market starts being red and you start seeing, you know, days where your portfolio is down like thousands of dollars and your portfolio is down 2, 3%, here's what you do: you got your phone, you turn it off, and then you throw it away. All right. That's probably the best thing you can do, because I feel like as investors, as traders, people make too many irrational, emotional decisions when they start seeing red in their portfolio. Because yesterday you thought that AI was the God-given right for everyone. It's gonna change the future, and then boom, you find out it's a bubble, and the stock starts going red, and all of a sudden you're like, no, AI's a lie. It's over. It's a bubble. Markets do not, like, your sentiment shouldn't change on a daily. Maybe it should change on a monthly basis or a yearly basis. But if your sentiment is changing on a daily basis or hourly basis, then maybe investing and trading is not for you. Because I feel like, every investor and trader, you need to lose some money for you to learn a lesson. And I think it is an expensive lesson, but it's a lesson that will truly keep you in the game long term. So for me it did, like, it took me a while. Like, I've made some dumb decisions early on where I sold a stock off, like, I panic sold, or I panic sold, and then you find out that the next day, or like in a week or a month, everything's fine, the market's back to normal. And then I feel like as a beginner, you have to make these mistakes. So I don't blame anyone for panic selling. It's something you got to learn. It truly is, like, investing is a journey. It's truly a process. And it is, I would say, it's more of a psychological game more than like a technical game or a fundamental game. So for me, when it comes to red days, I'm not saying, hey, you should buy every single dip you see, but what I would say is, when you see red, when you see all these CNBC headlines and all these fear videos from content creators, I would say is, you stop in your tracks, you take a breath, and you truly see the plan laid out, and you go like, hey, is this situation really as bad as they say on the news? Is this really as bad as they're saying on social media? And then you make your decision. You don't want to start selling and pressing buttons right when you see the market move. But it comes with time. It definitely is a practice.
Now, I've seen a ton of creators create the videos of buy these stocks now, and typically those videos are a quick flash of the ticker, a stock, and like a personal opinion. Bilal, when I see your content, I actually see legitimate rationale. You just posted an Instagram video the other day I watched, and you went in depth with a lot of the top five picks that you had in that particular video. So I want to know from you, like, how much research should be poured into your investments before making them? What are some of the fundamental metrics that should be looked at? Which ones can we avoid, or really are just, noise and distractions from the reality of the company?
Yeah, the problem nowadays is, this is the age of information. So we have so much information, and with ChatGPT now, I think it only multiplies it even more. So we have so many avenues where to find information and research, but sometimes the research and information might not always be real. And for me, I always the problem is, whenever someone picks a stock, they always choose to go the bullish way. They always try to find the good news. And I think investors make mistakes because you want to be a contrarian. You want to be skeptical. I've always been a very skeptical person, right? I never think this is the magic potion, or this is the beans that will grow all the way to heaven. So I always like to have the bull and bear case. So I like to find out, hey, what's something that's working for this company or stock? What are the good things? But what's also the bad things? What are the negative sentiment? What are people saying? What, because for every stock, behind the stock, there's always there's people buying and there's selling. There's people shorting and there's people that are going long. So why is that guy shorting and why is that guy going long? Okay, I've got that case out of the way. Now let's look at the fundamentals. And I'm not gonna bore you here, but at the end of the day, a business, a company's main job is to make money. And it shocks me when people pick a stock that makes absolutely no money and is just negative income every quarter after quarter, but they're promising these big dreams, right? Hey, we're gonna launch rocket ships. Hey, we're gonna make these robots. Okay, that's cool, but are you making money from this? No, so you have a chance of going bankrupt. Like, it's, for a company that's making profits and constantly reporting revenue and net income every quarter, it's very hard for that business to go bankrupt. You can try hard, but it's very hard for a company that's actually doing great things to go bankrupt. But then when you find a company that's, reporting loss after loss every single quarter, but people are still like, no, 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 they'll eventually will go up. now you're lying to yourself. So you wanna kind of see if how much debt a company has. Is it truly actually making money? Are they reporting great earnings? What are they actually doing? So yeah, those are some of those easy steps that people go through. Now for me, when it comes to researching a stock, what I like to do is I like to create a watch list, maybe 10, 20 stocks that I think are good every single month. And then in that month, I will be researching that company, whether it's watching other content creators' videos and seeing what their idea or view is, or it's just my own research, looking through the income statements, looking through the fundamentals, looking at the charts. So I like to study a stock or a company at least 1 month in advance. So and that's because let's say when it's truly time to buy that stock, and what I mean by buy that stock, let's say the stock falls 10%, 20%, maybe there's some news, maybe Donald Trump tweets something and the stocks start falling, then hey, I don't need to spend hours researching the stock because money moves fast and you need to be faster, especially in this market. Sometimes we see a stock falls 10% and the next day it's up 20%. It rebounds very quick. Money moves fast nowadays, but you need to be faster, and you can't do that if the stock falls and all of a sudden you're rushing to find information and research. No, I've already got the research done. I already know it's a good stock. I already know it's a bad stock. So when it's time to execute, I'm ready.
I love that. I love that. Now, just the other day, this video was hot. It was live. I watched it. Alphabet was the top pick that you had, and you were very bullish, it seems, on Alphabet. You also had posted about Meta when Meta fell. And the one thing that you did pull up was, of course, the income statements and the balance sheets, just showing that they were profitable, making money. The fundamentals didn't change. So, are investors, in your opinion, just not doing any real research? They're just grabbing names and investing into them for the name and the hype?
Yeah, see, that's a problem too because most people, they don't know what they own. And I always say know what you own and why you own it, because when the stock does fall, you're not going to be panicking because you're like, we'll give it. You talked about Google and Meta, so I'll give an example. So Meta, they own Instagram, they own Facebook, they own WhatsApp. Now, I was surprised to see when Meta was falling, people were actually panicking. They were like, "It's so over. Meta's done. They're never gonna recover. They've invested too much in AI. It's so over for them. Let's sell now." And they're posting all this information on their Instagram and their WhatsApp that's owned by Meta. I'm like, you're using Meta's apps to talk smack on that stock. I'm like, that's kind of contradictory. And when I saw that, I'm just like, what are you doing? I'm like, okay, let me buy more Meta because you're bashing the stock on their own app. So it's like you gotta know what you own and why you own it, because you'll never panic. Like every company I own, I know it from like the back of my hand. You can ask me questions and I can answer it, right? And and when the stock falls, well, I just go back. I step back and I go, well, is Meta still executing? Are they still growing their Instagram users? Am I still getting followers every day on Instagram? I am. Okay, I don't need to panic. I'll just buy more.
So, in this case, do you think you need to be a user or a consumer of the products and services of these companies? Or, like, if it's first one, of course, that comes to mind is Procter and Gamble, but it's everywhere in someone's house. Let's talk about like an
Yeah.
Oracle, right? Or a company of the alike. When you find this stock that you think is attractive, do you need to use the service? Do you need to use the products? Or is it okay to know of the company and not really be a user?
Yeah. I think so. I think you can know of the company and not own it, but it is in your best interest to kind of invest in companies use or own or work in that sector. Like you can work at Meta, but you can still understand what Google's doing because you're in that same sector. You're in Silicon Valley. Now, for me, I might not use every single I'm not really a consumer, so I don't use every single product. But then I have friends, I have a girlfriend that's a big consumer, so I kind of do my market research like that. Like like let's say, like there's a hot brand called Aritzia, and obviously I don't wear Aritzia, it's girls' clothing, but I see my sister, I see all my girlfriends, my own girlfriend, her closet is full of Aritzia clothes. And every time we go to the mall, the first place she wants to go to is Aritzia. Now I'm like, okay, let's do some market research here. I walk into Aritzia and I see girls everywhere just going crazy, spending $100 on sweatpants. And now I'm like, hey, let's go look into this stock. Whoa, look, the stock is down 20-30% this year. This might be a great trading opportunity. This might be a good stock opportunity. And based on just that information where I saw almost every girl in my life just, loving Aritzia, spending tons of money at Aritzia, that allowed me to kind of make that choice of, investing in Aritzia, watching the stock go up, and then I sold it. Now the reason why I sold it after a year was because um I truly never understood the company completely because I don't wear the brand, right? But I just saw what was around me, and this is called social arbitrage investing, where you see a company's hot on the news, hot around you. You see consumers chasing that brand, and I was able to use that information to invest in that company. Now, when it comes to people, now I work in the tech field, I work in the engineering field. So for me, I got lucky to the point where, because I'm an electrician, I kind of see where the money is truly traveling. And because of that, I was able to invest in a company called Kamiko, which is a uranium provider. I'm seeing, you know, because of AI, the demand for electricity is rocketing. In the next 10 years, where it's known that the demand for electricity will quadruple. So I know that nuclear is probably the only best source of energy to meet that demand. Solar and wind is way too slow. Nuclear is powerful enough. So that kind of, that was a great thesis for me to invest in a uranium stock, and that has truly performed pretty well for me.
It's very Peter Lynch esque of you to do this type of market
I love
research,
Peter
and
Lynch.
more importantly, be on it though, because there are quite a few people who are out there. I was having a conversation earlier today. People like to throw quotes around, whether it's quotes from Warren Buffett or Peter Lynch or their favorite athlete. But when it comes time to shine, to follow through on that good old cliche quote, they're nowhere to be found. So it's just good to actually see someone who's reading Peter Lynch, Warren Buffett, and putting those quotes into action. You did say earlier that money moves fast, which I agree with you entirely. Now, in saying that money moves fast, and you have to be able to make quick decisions, especially when you spot the trends. Do you keep a lot of capital on the sidelines? Do you throw everything you have into the market when you have the chance? How do you go about actually investing the capital once you earn it?
Yeah, so when I first started investing, when I was trying to reach that $100,000 mark, I was truly investing everything. I just wanted to get my money out of my bank into the markets and let that money grow. Now that I'm at a place of, I would say, comfort, where I don't have to kind of chase those portfolio goals, I do like to keep a lot of capital on the side. Now, just in my portfolio alone, I like to always keep a healthy cash balance of 10 to 20% in the overall portfolio. But in the bank, I do keep a lot of capital, and that's just because I know what happens during times of market crashes. Now, none of us can ever time a market crash, but when you start seeing, some signals, when the markets are, reaching euphoric stages, that's when I kind of like, start slowing down on investing, start raising capital, start doing that overtime shift. And that's just because, I'm just waiting to execute. I'm waiting to jump on that trade. But like I said, this is because, I have a $500,000 portfolio. I've already got enough skin in the game where if the market continues to go up, I'm not worried. All right, I save some cash, it's all good. But when I had a smaller portfolio, no, I wanted to be at least 90 to 80% invested. Have an emergency fund. I like to keep at least 1 year's of expenses or salary, just in case something goes wrong. Like I said, I am taking care of my family. I am taking care of my parents. So in case there's any bills or anything unexpected, I do live in Toronto. You never know what's gonna happen. Cars get stolen, so I still have that emergency fund. But no, right now, I'm in a place of privilege. I'm in a place of comfort. I got cash. If I get a dip, I'm going all in. If I don't get a dip, it's all good. I got enough skin in the game.
From the BD investing standpoint, where exactly are we right now? Are you putting money aside?
Right now I'm saving money, man. I think the market's at euphoric stages. We did see the this dip the last 2 3 weeks with the whole case of a AI bubble. So I'm not gonna lie, I did go in because I think when great companies fall 20 to 30%, you do want to kind of dive in. And from a technical perspective, a 20 30% drawdown is considered a correction or a crash. So when you have, most algorithms are designed to start putting money into these stocks when they fall 20 to 30%. And that's just their, that's just a technical programming on the algorithms. So yeah, I did go shopping the last couple of weeks, but would you say, am I buying hand over fist? No. I think we probably got maybe 2 3 months, maybe 6 months left of this bull market before we see maybe some kind of correction. I'm not saying a crash. Maybe we're gonna see some volatility next year. I mean, the market has gone up. Has gone up for the last 2 3 years. I was able to make $500,000. So if a guy like me who's making $500,000 within 2 3 years, that should be a sign that, hey, maybe we're reaching that level. Maybe we're reaching exhaustion in the market, right? So I think we need a couple pullback. We need the market to humble a couple people, because we are also seeing a lot of young people, a lot of these TikTokers just throwing any single stock right now, and it goes up, and their followers are like, oh my God, you're a genius. This 18-year-old should be worshipped. And that's a red flag, in my opinion.
I totally agree with you. And I'd like to caution every investor out there that you got to be careful who you're listening to, which is a question now in and of itself. How do we know as viewers, as listeners, who to trust?
It's hard because, um, you know, people would be like, hey, why should I trust BD? Why should I trust Ari? Why should I trust this individual? You don't have to be the smartest person to give great, stock picks or investment thesis, right? You don't have to be the smartest. I'm not the smartest guy, but I'm consistent. I do my research. Now, one thing I would say is, if you're gonna follow, a content creator, make sure they are transparent. Make sure they're showing their portfolio. Make sure they're being transparent where their money's going, what their portfolio is looking like. You cannot blindly trust someone who you don't even know what they're truly doing behind the screen, right? Um, when in my early investing stages, I used to watch YouTubers. I'm not saying I'm perfect. I used to blindly follow some of my favorite YouTubers. And I'll give an example. Like I followed this one individual on a Tesla stock trade back in, like, during the COVID times. And everything was going great. Tesla stock was performing well. And then something happened and the stock dumped like 20 30% overnight. And then, I'm like, well, I need answers. Let me go on this guy's YouTube. And then he had the audacity to post on his YouTube, oh yeah, I sold the stock before the crash. What? And you didn't tell us? How do we know you actually did that? Like, he sounded like a genius, right? Oh yeah, wow. He saw the dip coming. People were praising him in the comments. Wow, this guy's a genius. He saw the dip coming. But I'm like, no, no, no. I'm skeptical. You should be in a loss just like me, because you were telling us to buy every single day, but then when it came to sell, there was no signal. We didn't know what you did. But now this is why I joined Blossom, because Blossom changes that. Blossom shows you when someone makes a trade, whether it's a buy or a sell. You get to see their portfolio. You get to see how much they're up. Like, I'm not now, if I'm gonna fall, like, Ari, if you were to post like a stock you like tomorrow, well, the first thing I'm gonna do is go on your portfolio on Blossom. I'm gonna see, hey, is this guy's returns good? Does he even own this stock? Because now we have people that are getting paid to promote certain stocks or ETFs, but they don't even own it. And I'm not saying that's bad. It's just, I'm not gonna own a stock that you're promoting that you don't own or cover anywhere on your Blossom portfolio. And I think transparency plays a big key. And that's one of the reasons why I show my portfolio, is because I want you to see my losses. I want you to see the imperfections I have. I don't want anyone to worship me or think that I'm a stock god, because I truly make mistakes. Hey, Warren Buffett makes mistakes, all right? Warren Buffett has had stocks that didn't do so good. Peter Lynch had stocks that didn't do so good. And for me, it makes me happy to know that the people that I look up to make mistakes because they're human. And I want my followers to know that I'm also human. I might not get it right all the time.
That's crucial for everybody to really understand. And I even think worth repeating that transparency is key here, because if you're following someone who's promoting something, they're not actually invested in it, which we are seeing more and more. Well, chances are, you're listening to someone who's just actively promoting because they're getting paid. And now is it really worth the investment? I follow, I believe, 8 people on Blossom, if I'm not mistaken. You are one of them. I see when your buys come in. So BD is certainly transparent as transparent gets. What do you think the biggest mistake for all investors, if you had to just narrow it down to one mistake that investors are making time and time again, or that you're just tired of seeing occur, what would you say that mistake is?
If I had to truly get down to it, I would say is people panic too fast and people get euphoric too fast too. No one it all comes down to emotions. If you're gonna take anything from this podcast, I would say is you need to work on being stoic. You need to work on controlling your emotions. And I'm not gonna lie, the stock market actually has taught me to control my emotions. I'm cold blooded now, baby. Nothing changes me, nothing excites me, nothing moves me. When I see my favorite stock go up, um, well, okay, I'll clap. I'm like, wow, okay, great, stock went up. Okay, it can go down tomorrow. Same way when a stock goes down, it doesn't move me. For me, I've controlled my emotions to the point where, um, it all goes back down to my research and my fundamentals, right? So a lot of people nowadays, the minute a stock falls down or a crash happens, my DMs get flooded. Oh my God, why is the stock down 2%? I'm like, are you seriously worrying about a 2% drawdown on a stock? Like, are you that fickle? Are your emotions that weak that a 2% drawdown is gonna move you and shake you? So my advice to beginners is learn to control your emotions, learn the psychology of the market. There's a lot of books, there's a lot of books on stoicism. There's a lot of books on philosophy that truly help you master your emotions and just be a better individual overall. Because for me, um this development has helped me when it comes to life. Like when like let's say my car breaks down, I don't panic and go crazy. I go like, well, you know what? The car, it was eventually gonna break down. It's done me well for the last 3 years. I'm just gonna call a mechanic. I'm gonna get it towed. Everything will be fine. But I've seen people where they get a flat tire and all of a sudden it's the end of the world, and you're just making things worse because you're gonna make a rational decision. Maybe a tow truck driver comes and he's gonna charge you $500, and because you're panicking, you're gonna say the first thing you're gonna say is yes, versus what you should do is call up a bunch of other tow truck drivers, see if there's a cheaper one. Maybe your buddy can give you a ride. Maybe he has a tow, right? So I would just say when things get bad, just slow down, think things through, take a breath, and control your emotions.
There's a book out there, Richer, Wiser, Happier. Phenomenal read about some of the greatest investors of all time and how they approach the market. And the reason I'm bringing this book up is because you actually nailed what a lot of these investors do, which is they're not necessarily studying the market itself. They're studying stoicism. They're studying the different arts that are out there to learn how to think, generally speaking, how to think and how to react. So, which books have you read, or would you recommend for all of us? At least 1 or 2 books that have helped with stoicism or just generally becoming an overall better person.
Yeah, there's this one book by Aurelius, who's one of the greatest philosophers. I think I can't remember the name of the book, but I know it's like How to Be Stoic. There's another book called Thinking Fast and Slow, which has direct impact with the stock market. Very great book. Another one by Peter Lynch is A Walk Down Wall Street. Now he nails down, like, if you're gonna read any book, it's that one by Peter Lynch, because I've mentioned a lot of quotes from Peter Lynch, and obviously Ari's read that book because he's caught me here, quoting the great Peter Lynch. But I think he does an excellent job on market psychology. He market psychology, how to know how to invest, where to invest, and also controlling your emotions.
2026 is literally around the corner. Where are your eyes on the top three stock picks for 2026?
Ooh, you're gonna make me pick some stocks on your podcast, Ari. All right, so
Let's go.
first and foremost, not financial advice. Make sure you guys always do your research. But three stocks that are on my hot list that are not Magnificent Seven. Number one, I gotta say AMD. I love Lisa Su. I think she's an excellent CEO. AMD, if you don't know, is a semiconductor company. It's a rival for Nvidia, and right now we're seeing a drawdown on AMD. We're seeing a lot of people panicking, and you can say that Nvidia might eat AMD's food. But where AMD excels is the data center revenue. They're truly growing, and I know Lisa Su just announced that they're expecting 80% annual growth rate over the next 5 years, which is very great to see. And I actually think Lisa Su is sandbagging here because she usually sandbags, and I think we're actually going to go higher because the thing with Nvidia is those chips are way too expensive. So some customers want to kind of be cost efficient here, and they might choose AMD as the secondary chip. Look, number two. Number one, you can be number one, you can be number two, but even number two can still win sometimes. The second stock I would say, which is not an AI stock, is SoFi, which is not a traditional bank. It's one of those online banks, and I think SoFi and their CEO are doing an excellent job. They just got into the crypto space. Now, this is the first bank in the U.S. that's going to the crypto space, and it's truly giving young people and the traditional bankers the option to invest through crypto through a bank with because some people have concerns of crypto's not safe. They're still skeptical on it. So SoFi gives you the opportunity to go the traditional banking way to invest in crypto. And SoFi, their members are growing. They're up at 12.6 million right now. I think they're gonna hit 13 million, and they're constantly growing. And I see a lot of young people getting loans and investing through SoFi. So I'm very bullish on SoFi. And the third stock, I'm gonna give like a small cap stock. This is a little bit more risky, and I call it a moonshot because it's 0 to 100, and it's called Nebius stock, ticker NBIS. Now, this is a company based out of Amsterdam in the Netherlands, and they are a data center company. And if you go open up like the whole Nvidia Circle Money little diagram, you'll see that Nebius is one of those companies. Now, Nebius, what they do is they're a cloud data infrastructure company, meaning companies like Meta, Amazon, Google, they will hire and contract out Nebius for their data center infrastructure. Meaning, Nebius will own a bunch of chips, bunch of data center infrastructure, and they will rent that out to Google and all these hyperscalers. So because they can't own because there's not enough data centers around, you have these companies like CoreWeave and Nebius having neo cloud data center infrastructure. And I think that's an excellent like a business plan to rent out your infrastructure and your chips. And they're actually backlogged, meaning there's so much demand that they don't have enough supply to meet the demand. And usually when you see that, that's pretty bullish. So I do think the stock is going to see some ups and downs and some roller coasters. But I don't think they're gonna go anywhere soon. I don't think they're gonna go bankrupt. And now you should know that this is a small position in my portfolio. I think it's about 1 or 2%. So this is not a sign to go and get a loan from the bank and put all your money in. I would say do your research on this company before you invest in it.
Again, just to reiterate, none of that was financial advice. But of course, if you're looking for at least suggestions on where to put your eyes, BD's got you covered. He just did so with three stocks here, but he's doing so literally almost every day on various posts. So you have to go follow him across social media. He's big on Instagram. Of course, Blossom, he's putting out a lot of posts as well. BD, it's been a true honor to have you on Masters of the Market. Incredibly insightful. Hope to have you back on in 2026 when you see hit that millionaire status. Fingers crossed
Let's
and
go.
sooner rather than later. And investors, until the next go round of Masters of the Market, we will catch you in the next one.